Welcome back. Let's take a look at how the markets are performing now. The interesting element here is that yesterday we saw the U.S. services sector perhaps rebound and come back ever so slightly. So perhaps some hope that the U.S. economy is beginning indeed to recover. But unfortunately, the increased number of COVID-19 cases in the United States has meant that there needs to be some sort of slowdown when it comes to whether it be things like restaurants or the opening of sporting fixtures, as you may have seen before the ad break as well. So unfortunately, it did put a dampener on this market picture. You're seeing the likes of the Hang Seng and the Nikkei out in Asia going down there as well. The biggest faller there is in Hong Kong, 1.4% going down is that Hang Seng. A negative picture out in Europe as well. Unfortunately, the increased cases certainly playing its role and not helping the market any bit, perhaps not so much in terms of the speed of recovery that we're expecting and hoping to see in that market picture. Slight fall as well on the local front for the JSE All Share, just over 0.1% there. The biggest losers today are the financial counters, going down more than 1%, while the industrials did manage a 0.4% gain on that front. It seems the gold indices still taking in some of that safe haven trade as they went up nearly 1% today as well. So a good picture overall on that front, with resources unfortunately closing down. But overall, though, the market unfortunately going down 0.1%, as I said. Onto the commodities board then. Brent crude unfortunately going down and wilting away ever so slightly, 0.8% lower, $42.76 a barrel. Indeed, again, the increased number of COVID-19 cases does mean that less demand will come out of the United States. And even though WTI is the one perhaps we should be looking out for, OPEC has been the only thing that has kept prices pretty much stagnant and where they are right now, and perhaps even above that $40 a barrel mark. The question is, can supply remain at these levels according to OPEC and its allies? Will they maintain that stance? Because if they do, we're bound to see that oil price perhaps trickle a little bit higher later on. But a good day for platinum so far, 1.4% to the good, $823 a fine ounce. Gold sitting at $1,777 a fine ounce as well. Onto the currencies board, weakness then for the South African currency, past 17 Rand again then, 0.7% weaker today. That's 12 cents in fact, 17 Rand and 10 cents against the US dollar. We had hoped to see some sort of recovery and perhaps even a stay below that 16 or the 17 Rand mark, having seen those better numbers come out of the United States when it comes to the jobs data. But our very own factors, including S&P, saying they don't believe South Africa can indeed keep up with its debt scenario, as well as the negativity of increased COVID-19 cases globally, certainly not boding well even on the local front. It's 19.30 for a euro, and a pound sterling will set you back 21 Rand and 40 cents. Let's have a chat then to Shaun Murison from IG South Africa as we unpack this market picture. Shaun, we had hoped the Rand stays above 17 Rand, unfortunately not to be.
Yeah, there's always give and take in this market. The Rand has had a good run. If you asked us about 2 months ago whether we were back at 17 Rand when we were trading about 19 and staring 20 Rand to the dollar now, I think we'd have been happy with these levels. And I think that's exactly it. Showing a bit of risk-off trade in the markets. It's a nice bellwether sort of or proxy for risk in the market. And now, that's a bit of a risk-off day, and we're seeing the Rand selling off, in line with that global sentiment.
Yeah, sustainably, where does it sit though? Is this an undervalued Rand still at these levels?
So I think probably a fairer value for the Rand is closer to 16 Rand 50 to the dollar. But at the moment we're trading in a broad range between about 16.50 and 17.50. So while that might be a fairer value for the domestic currency, it is sort of that ebb and flow, and those spikes of volatility are dictated by what's happening externally. Last couple of weeks have been good for the Rand. At the moment now, we have a bit of nervousness creeping into the market and coming off. So it's sitting in the middle of that range. I think all things being equal, without the global sort of pandemic risk and the risk to the macro picture, I think 16.50 is a fair value. While this is still going on, I think we can expect the volatility, and that range takes us up to anywhere up to about 17.50 in a sort of short to medium term picture.
Yeah, we certainly are seeing, though, that a lot of the stock markets across the globe have certainly begun picking up. And Is it perhaps, have we seen the worst of it? I say that because the likes of the S&P 500 climbing then as well to beyond 40% thus far. The NASDAQ climbing still to all-time highs as well. And even though there are more COVID-19 cases, it seems that the market may not necessarily be looking towards that and looking elsewhere perhaps.
So at the moment, yeah, the NASDAQ, a lot of those companies in the NASDAQ are quite resilient, the online e-commerce type businesses. But yeah, in a general picture, I think what we need to do is just sort of understand where we're at. At the moment, we have unprecedented amounts of monetary easing, economic Arabile interest rate, and all major and developing are at historical lows. And these are generally very, very supportive of equity markets. And so we've had quite a strong run. It does make people uneasy because we know that we're not, the business side of things haven't picked up accordingly. But certainly as economies start to reopen, or as they are reopening and rules get relaxed, that is a suggestion that we can get going. And certainly with the boost of lower interest rates and quantitative easing, that does support business and does support the equity markets. It's when you enter logistically, when we're going into lockdown and supply chains get disrupted, that's when that stimulus has little effect because it can't get to where it needs to go.
Yeah, that's the unfortunate part, and unfortunately. Okay, so what happens then from here on when it comes to the price of oil, though? I mean, down today, but can we really pin our hopes on OPEC and its allies, OPEC Plus, then deciding to keep their supply at these levels and perhaps even lower at some stage?
So I think last I looked, the current supply, the output levels, and assuming full compliance by all the OPEC and OPEC Plus members, is sitting at levels not seen since 1992. So it is historically, these are, again, I like to use that word unprecedented because it's extraordinary what's happening in terms of the level of output that has been cut. But it is reliant on the demand side because there is a surplus of oil still within the market. That surplus is expected to remain, certainly through 2020, well into 2021. So I think to have a real effect that they're going to have to keep that supply curve cut, and we're going to have to back the fact that that economies aren't going to move back into major economies aren't going to move back into more sort of hardcore lockdown phases.
Yeah. Does the gold price get back towards $2,000 a fine ounce at some stage? It seems to be pretty stagnant at this stage, and one would have thought that it becomes the actual safe haven in a time like this, but seemingly not.
Yes, and a hedge against inflation. Unfortunately, we haven't really seen inflation, or despite the fact that the Federal Reserve's mandate is towards they've been trying to trigger inflation. A lot of the easing hasn't actually equated to hasn't manifested in inflation. However, safe haven demand for gold. I've been watching this gold price, and I agree with you. It has seemed the movement has been lackluster, but it's been drifting higher. And I was not surprised to see that we're actually trading around about levels that we haven't seen since about 2012. So it's we were trading around 8-year highs. I think definitely. I think there's enough shock factors coming. We got U.S. earnings season coming through now. I think we're going to get some surprises to the downside. Some concerns around economic, the state of the global economy. And I think I'm a bull on gold. I'm not a conspiracy theorist, but I do think that this is a bit of a time for gold to shine. Above 1,800, I think we could actually see quite a quick move back to 1,900 and in the medium term, maybe even $2,000 per ounce.
Ooh, a medium-term bull on gold. All right, Shaun, appreciate the time. Thank you so much for that. Look forward to having a chat with you again then as we unpack that market picture. Shaun Murison is from IG South Africa. Let's get back to you with some company news after the short break. Do stay tuned to SABC News. We're back right after this.